So, how do global economic shifts and, these constantly changing financial landscapes really play out for a company like Moody's? I mean, they're shaping how we understand risk and credit.
It's a huge question, right? And today we're diving into Moody's latest numbers, straight from their Q2 2025 Form 10Q report.
Exactly. And we're not just going to read off the numbers.
No, definitely not. The goal here is to cut through the, let's say, the corporate speak
Right.
and pull out what really matters. We want to understand the market forces, the strategy behind the numbers, and what it tells us about the wider economy.
Absolutely. Our mission, really, is to give you that shortcut to getting what Moody's is up to. We'll look at the two main parts, Moody's Analytics, MA, and Moody's Investor Service, MIS, how they did, why they did it.
And what it means for all of us, basically. There are some surprising bits in here, some real aha moments, I think.
Definitely. Okay, so let's start with that snapshot. Moody's overall financial health, the key trends from this report. Top line first.
Yeah, let's do it. Total revenue for Q2 2025, it came in just shy of $1.9 billion.
Wow. $1.898 billion. How does that compare?
That's a solid 4% increase compared to last year, year over year. And what's interesting, it's not just a one-off quarter.
Okay.
For the first half of 2025, so the first 6 months, revenue hit $3.822 billion. That's up 6% from the first half of 2024.
So consistent growth then. That definitely speaks to some resilience, especially with market ups and downs.
Exactly. It suggests Moody's isn't just, reacting to the market, but they're actively finding ways to grow their revenue streams. Pretty impressive.
Yeah, that sustained growth is key. And what about profit? How did that shake out?
Profitability looked pretty good, too. Net income, the part attributable to Moody's was $578 million in Q2. That's up from $552 million last year.
Okay. And earnings per share?
Diluted EPS saw a 6% bump to $3.21. But the adjusted diluted EPS, that's where you see an even bigger jump, up 9% to $3.56.
Right, the adjusted numbers. They often paint a clearer picture of the core business performance, don't they? Stripping out the one-offs.
Precisely. Things like restructuring costs, maybe legal stuff. So when that adjusted number is higher, it tells you the underlying engine is running really well, even better than the headline number might suggest. Strong operational performance.
Speaking of operations, efficiency. Saw some interesting points there. The main operating margin nudged up slightly in Q2, 43.1% from 42.7%.
Yeah, a small expansion.
But year to date, it actually dipped a tiny bit. What's the story there?
That's a great point. So while the main JAP margin dipped slightly year to date, the adjusted operating margin, well, that showed really strong expansion, up to 50.9% in Q2 from 49.6%.
Okay, big difference. Why?
It comes down to that revenue growth we saw, but also, critically, the benefits kicking in from their restructuring program, plus just disciplined cost management.
So they're getting leaner behind the scenes, even if some restructuring costs hit the main margin initially.
Exactly. They're tightening the belt where it counts for ongoing efficiency.
That makes sense. And this efficiency focus is crucial given how global they are. U.S. revenue was, 52% in Q2?
Yeah.
$992 million?
Right. And non-U.S. was the other 48%, so $906 million. Pretty balanced.
That balance seems important for stability. Where's the non-U.S. growth coming from?
Well, the standout was EMEA. That's Europe, Middle East, Africa, up 8%.
Wow.
Yeah. Asia-Pacific followed at 6%, and the rest of the Americas grew 5%. It means they're not overly reliant on just one region, spreads the risk, taps into different growth spots.
Provides that stability. Good point. And another key piece, their revenue mix. 63% recurring in Q2, 37% transactional. That move towards recurring, that's very deliberate, isn't it?
Oh, absolutely. Massively strategic.
What kind of changes like investments or operational shifts do they have to make to get that mix? And what does it mean for, keeping competitors away?
It's a huge pivot. Think about it. Their traditional ratings business, MIS, which we'll get to, that relies a lot on market issuance, which can be unpredictable.
Like deal flow.
Exactly. Recurring revenue, especially from the analytics side, it gives them this stable base. Predictable income lets them invest in innovation, handle market bumps better. It's moving from chasing deals to building long-term sticky relationships, makes the whole business much more resilient.
That's a powerful shift. And like you said, Moody's Analytics, MA, their intelligence engine, that's where you really see it. MA external revenue hit $888 million in Q2,
Yeah.
11% increase.
Yeah, really strong growth there.
What's driving that surge?
It's coming from a few places. Continued high demand for their Know Your Customer, KYC tools.
Sad stuff.
Right, and their insurance offerings. Also growth in their SaaS banking solutions, software as a service. Plus, strong demand still for credit research and their ratings data feeds.
So it's not just selling more, it's selling these critical ongoing services businesses need.
Exactly. Essential tools for navigating complex markets. And it's sticky.
Yeah, you see that in the organic constant currency growth, 7% for Q2 in the first half. And annual recurring revenue, ARR, up a strong 8%. Really underscores that subscription model in MA. Let's break down MA a bit more. Which parts stood out?
Okay, within MA, the real star was Decision Solutions, or DS. Revenue there jumped 13% to $413 million.
13%. What's in DS?
Two big drivers there. Insurance revenue soared 14%. That's fueled by new subscription sales for things like catastrophe models, plus the impact of companies they bought recently, like Predicat and CP Analytics.
Ah, acquisitions helping too.
Definitely. And that insurance part is 96% recurring revenue, almost entirely subscription.
Wow. And the other driver?
KYC, Know Your Customer. That revenue jumped a massive 22%.
22%. What's fueling that kind of demand beyond just, ticking the compliance box?
It really shows the global pressure on compliance, right? More regulation, but also just the sheer amount of data companies need to handle for risk assessment. And the key thing with KYC for Moody's, it's 100% recurring revenue.
High growth and totally predictable. Powerful combo.
You got it. Also within DS, banking revenue grew 5%, mostly from recurring, which was up 10% thanks to growing customer deals and another acquisition, Numerated.
Okay.
And that growth happened even though transactional banking revenue fell 11%, which actually fits their strategy, right? They want to shift away from transactional towards subscriptions.
Right. Very intentional. Okay, what else in MA? Research and Insights, R&I.
R&I revenue was up 10% to $249 million. That's driven by selling more credit research products and keeping existing customers happy, better retention, and again, super high recurring revenue, 99%.
And the last piece, Data and Information, D&I.
D&I revenue up 8% to $226 million, mainly demand for ratings data feeds, plus a little help from favorable currency exchange rates, also 99% recurring. So yeah, MA is firing on all cylinders with these recurring intelligence-based solutions.
That's impressive growth, but it doesn't come free, right? What about the costs associated with driving MA's expansion? Operating and SG&A expenses for MA were up $28 million.
Yeah, mostly higher salaries and benefits, basically more people to support the growth, plus annual raises. It's the investment needed to fuel that expansion, getting the talent for those high priority areas.
Makes sense. Cost of growth. Okay, so while MA is the high growth intelligence side, let's pivot to the traditional powerhouse, Moody's Investors Service, MIS, the rating authority. Its performance is often seen as a kind of a market barometer.
Right, the core ratings business.
So MIS external revenue was $1.010 billion in Q2, basically flat compared to last year.
Yeah, pretty much in line year over year for the quarter. But looking at the first half of the year, MIS external revenue actually grew 4% to $2.075 billion.
Okay, so year-to-date is better. But you mentioned organic constant currency revenue declined 2% in Q2.
It did for the quarter. But the year-to-date story shows strong investor demand and tight credit spreads are still supporting growth in areas like investment-grade bonds, U.S. public finance, project finance, and CMBS commercial mortgage-backed securities.
Got it. But that growth was offset somewhat by declines in bank loans. Why was that?
Mainly market volatility and just less M&A activity happening, which often drives bank loan issuance. So a bit of a mixed bag, reflecting broader market conditions.
Makes sense. So how did the specific business lines within MIS perform? Did they reflect these dynamics?
They did. Corporate Finance Group, CFG, saw revenue dip 2% to $512 million in Q2.
Okay.
Primarily because of fewer bank loans being issued, especially in the U.S., compared to a really strong Q2 last year. It was partly offset by more investment-grade deals and just annual price increases they pushed through.
And CFG is still quite reliant on transactions, right?
Very much so. It's about 66% transaction-based, 34% recurring, so sensitive to issuance volumes.
Right. What about structured finance, SFG?
SFG saw a modest 3% increase to $135 million in Q2. Pretty consistent across different types of assets. And year to date, they got a boost from more CMBS issuance. That segment's a bit more balanced, 57% transaction, 43% recurring.
Okay. And Financial Institutions Group, FID.
FIG revenue declined 2% to $191 million in Q2. That was driven by lower volumes from less frequent issuers in the U.S. insurance space.
Interesting.
Partially offset by some growth in banking issuance, but FIG is heavily transactional too, 66% transaction, only 30% recurring. Very sensitive to individual big deals.
Okay. But one bright spot was Public Project and Infrastructure Finance, PPIF.
Yeah, PPIF grew a solid 5% to $162 million in Q2. That reflected more issuance in U.S. public finance, state and local governments, universities, plus those annual price increases again.
Does that 5% growth signal maybe a comeback in public financing, or is it just Moody's being essential in that space?
Probably a bit of both. It suggests some renewed activity in muni markets, which is positive. But like CFG, it's also heavily transaction-based, 70% transaction, 30% recurring.
So if we tie this all back to overall rated issuance volumes, year-to-date 2025, total MIS rated issuance was up just 2%.
Right. That headline 2% growth kind of hides what's happening underneath, doesn't it?
Seems like it. What are the...
Well, investment-grade bonds and leveraged loans saw pretty significant increases, up 9% and 10% respectively. So strong appetite there. But high-yield bonds, structured finance, EP, and PPIF volumes were all down slightly, like 2–3% each.
So a selective market. Investors are favoring certain types of credit over others.
Exactly. It's not a risk-on free-for-all. And profitability for MIS. Adjusted operating margin improved to 65.1% year-to-date. That looks good.
Yeah, but the report mentions a positive impact of prior year regulatory investigation reserves. What does that actually mean? Did they just get some money back?
Essentially, yeah. It means they'd set aside cash for potential regulatory fines or settlements in past years. Either those issues got resolved for less or the risk passed, so they don't need that reserve anymore.
Ah, right.
So that money flows back, giving the margin a bit of a one-time boost this year. Makes the underlying picture look a bit clearer going forward, too.
Got it. Okay, let's zoom out again. Broader financial and operational stuff across Moody's. Total operating and SG&A expenses went up. Higher salaries again.
Yeah, mainly salaries and benefits, reflecting more staff from growth and annual raises. Pretty standard stuff when you're growing.
And depreciation and amortization also increased.
Right. That's mostly from assets they got through acquisitions, plus software they're developing internally, especially for MA's SaaS products. It's an expense, sure, but it's really an investment in their tech and future growth.
Investment, right. And speaking of bigger shifts, they're in the middle of that big restructuring program, the Strategic and Operational Efficiency one. Approved late 2024.
Yep, multi-year effort.
Sounds like consolidating functions, maybe some staff reductions, optimizing their office space, basically trimming the fat to be more agile.
That's the idea. It often happens when companies grow, maybe through acquisition, and things get a bit scattered. They need to streamline, get back to core efficiency. Never easy, but clearly a long-term strategic move.
How much is it costing?
Well, through June 30th this year, they'd already incurred $105 million in expenses for it. And they expect another $120 to $150 million in cash costs through 2027. So it's a significant ongoing effort.
A serious commitment. On a related note, asset abandonment charges dropped quite a bit. Something about outsourcing sustainability content.
Yeah, seems like they decided to stop producing certain sustainability content internally and outsource it instead, so they wrote off fewer related assets.
Okay, let's talk cash flow. Net cash from operations actually decreased by $161 million year over year. Why, if revenue is up?
Two main reasons. Higher income tax payments, up nearly $200 million, and higher incentive compensation payments, like bonuses, up $100 million. So even with growth, more cash went out the door for taxes and paying their people.
Okay, but cash from investing activities swung positive. From negative $191 million last year to positive $98 million this year. How?
Mostly because more of their existing investments matured, giving them cash back. That helped offset the money they spent buying companies like Keepy Analytics.
Gotcha. And cash used in financing activities jumped by over $1 billion. That's a big outflow.
Yeah, two big drivers there.
Yeah.
They paid back $700 million of senior notes, basically debt repayment, in Q1.
Right.
And they also spent more buying back their own shares, treasury share repurchases. So deliberate choices to reduce debt and return cash to shareholders.
So all that resulted in free cash flow year-to-date of $1.140 billion. which is down a bit from $1.29 billion last year, reflecting those outflows.
Exactly, reflects those capital allocation decisions.
But they are still clearly focused on shareholder returns. The board approved a regular quarterly dividend, 0.94 cents per share.
And they bought back over 623,000 shares just in Q2. Still have about $109 billion left in their repurchase authorization, too.
So plenty of firepower left there.
And their cash position.
Still very strong. $2.3 billion in cash and short-term investments. A big chunk of that, $1.7 billion, is held outside the U.S.
Okay. And debt.
As of June 30th, about $7.2 billion in outstanding principal.
Right.
And like we said, they've paid off that $700 million chunk earlier in the year, so they're actively managing the balance sheet.
Clearly. Any other quick hits from the report?
Let's see. Stock-based compensation costs were $118 million year to date. Goodwill increased, which makes sense given the acquisitions. Right, goodwill, that intangible value like brand or customer lists they get when they buy a company, shows they're buying for strategic value, not just hard assets.
Exactly. They're also adopting some new accounting standards for taxes and expense reporting, which should mean more transparency for us analysts down the line.
Good.
And importantly, those new global minimum tax rules, the OECD Pillar 2 setting a 15% rate for multinationals. As of now, Moody's doesn't expect it to have a major impact on their full-year results.
Okay, good to know. So wrapping this up, we've gone through a lot of detail on Moody's latest report. The picture that emerges is a company really leaning into analytics, driving that recurring revenue.
Right. While strategically managing its global operations, its costs through restructuring, and its capital, it's definitely dynamic, adapting to the market.
And understanding these reports, getting into the weeds like this, it really gives you an edge, doesn't it? You see past the headlines, grasp the real strategy.
Absolutely. It's about being truly informed, understanding the story behind the numbers.
So here's a final thought to leave you with. As Moody's keeps buying companies and reorganizing itself around these high-priority growth areas, what's next? What new frontiers in financial intelligence, in risk assessment, might they be targeting? And how could that reshape the whole industry? Definitely something to keep an eye on.